So we're now recording. This is gonna be our first webinar. So we're gonna go over pretty much the basics first. A lot of you already know that I trade the institutional perspective, concept, whatever you wanna call it, of the market. Some of you are brand new. Some of you have taken my courses. So really what we're looking at is the intention of the market. So if I just draw a line right here at current price, to the left of the market, this is going to be the closed price that retail traders, the small fish, you and I, we're taught to analyze the market over here and try to predict the future. And what we do is we analyze, our resistance levels that you'll see like right here. So we have some resistance, and then we have support, and then we might have trend lines. I'm just going to draw here. This is just for example. So we have our trend lines, all kinds of different indicators, whatever we're trying to analyze this and using. And then we have the institutions, the smart money, the central banks, big hedge funds, everything else in the market. And those are the people that actually control the market. So whatever happens over here in future price, it's not really based off of these indicators and stuff. If there's, major news, they're going to push the market through your support or resistance, through your trend line, through your indicators. It doesn't matter. They control the market. They're going to move the market. So really indicators, you don't need them. It's not going to work. It's just reacting to the price action that the institutions and big banks give us, because they're going to do their thing. We're just trying to ride the wave with them. But we can kind of narrow down some of these setups that may be happening, because institutions can't always just pump the market forever, right? There's always someone buying and always someone selling. So if the institutions are trying to just buy, well, then retail traders will catch on and they'll be buying. That means there's no one on the sell side of the market. But we know, since the Forex market is so liquid, if someone's buying, someone is selling. So how the institutions move price to their intended direction, they create retail trading patterns and setups. So they might create, a double bottom. So we know retail traders are taught to buy. That means if retail traders are buying, the institutions and central banks can be selling, and vice versa. So really what we're looking at is, what is future price going to do and why did they do it, right? So we just kind of have to, like I said, react to what they are doing. But how we're going to kind of look at some of those setups is, we know as a retail trader, if you've been trading for a while, probably every course you've been through, every company you've been in, whatever it may be, your mentors, they teach you regular technical trading, or majority of them do. So what we're taught is, as a retail trader, if we have price, trending down, price is making these lower lows, lower highs, and then eventually price comes down to some support and starts making that like double bottom reversal, right? So right here would be our support area. And our intention is, as a retail trader, for price to make that double bottom, which would be the reversal. So we'd be looking for buys here. And then if price breaks that neckline of the double bottom, we would add more buys and continue the overall reversal and structure. So that's kind of what we're looking for as a retail trader, right? Just market structure and chart patterns. And the institutions know this. They know how retail traders trade, and they know where their pending orders are, because that's just how every retail trader is taught to trade. So if we were buying this double bottom with the intention of price going up, we are going to have our stop losses below the low. So right here, we would be buying at that support. I'm gonna go ahead and make this green. That way, we're buying at support. So we're buying here, and we would have stop losses below these lows. We're gonna make that red. And what retail traders do is put sell stops. It's called protective sell stops. Um, because if price makes a new low, so let's say we're in a buy and then price breaks and hits our stop loss, well, price has now broken that support and made a lower low. So we are told, okay, we're going to be short in the market. So we're going to hit those sell stops to make up that loss on the buys, right? So now we're intending the market to shoot down like that. But what tends to happen is we will see a spike down in the market, because if retail are buying, right? Retail's buying, buying, buying. That means the institutions are going to be selling. So they can use that liquidity to manipulate price to price them in at a better spot. So we'll see that bearish candle down through the lows. Let's go ahead and make this red too. And so now what this does, it clears out the retail longs. It hits their stop losses on the buys. So there's less retail traders in the market and longs. And now it hits all of these sell stops. So if retail traders are in sells because of their sell stops being hit, that means the institutions are going to be long. They're picking up the buy side. And then you see the institutions take over with that bullish engulfing candle right there. And so now we know that since the retail traders got taken out, they're not going to be in longs, right? They're going to be in sells, and that means the institutions are in their buys. So they're going to hold the market above that down move, because if they come back down like this, if price falls back down into here, they're going to let all the retail liquidity get out of the market and profit or break even. So if they're trying to bring price up, they need to have retail's traders in sells. So remember, because there's two sides of the market. So we're expecting them to hold price above that and keep retail traders trapped, and then go the intended direction. And now that you're looking at this example of a setup, how many times have you analyzed the market with your double bottom, you put your buy in, and then you went to sleep, you woke up and the market went your intended direction, but it stopped you out first? Or, you know, your pending orders were hit and you woke up negative, but you had a perfect analysis. You just didn't catch the trade. And that's what happens to a lot of retail traders, because they're taught the overall market structure, and, you know, they can predict the direction, but they don't understand the other side of the market, how they can just manipulate and price themselves in. So if retail traders are going to be short, that means the institutions can be long, and vice versa. So if the institutions say they want to bring price up to another, let's say this is a double top and there's liquidity here, and they want to come up here and grab this liquidity, well, the intention is going to be for price to rise, but they can't just pump price up. There has to be people on the sell side of the market, because they need retail selling in order for them to be buying. So they create these double bottom patterns and manipulate price down. So hopefully that's kind of making sense. I'm gonna go over a few chart patterns, because I literally only trade two different setups. It's going to be the kill shot and the sniper, we call it. So the two examples is really four, because two of them are bullish, two of them are bearish. So the first one is going to be, we have equal highs like this at a double top. So we know this is going to be retail selling. So we would have stop losses on the shorts, on the retail shorts. So the green line is the entry on your sells, red line is your stop loss. And then we have those buy stops in case price does continue up. We can enter our longs, right? Because we're trending up. We're just trying to pick the tops and bottoms. But so what happens is you'll see retail selling. So you'll see the double top looking like it's going to play out. So you'll see a little bearish candle. Everything's looking good. And then all of a sudden, your trade gets stopped out at break even, or your stop loss is hit like this, because the institutions can manipulate price, because if all these retail traders are selling, that means the institutions are buying. Boom, now your shorts are stopped out and your buy stops are triggered. So when your buy stops are triggered, that means the institutions can sell. So institutions are selling there, and then price trades lower, right? So what we're going to look at now is, we know the institutions were buying the sells in here. So they need to mitigate those longs because they are in shorts here and the intention is price to drop. So if they're in shorts here and buys here, well, all they have to do is take some profit off of these shorts, or, you know, push price up a little bit, whatever they may do, and come back to that down move that they were buying into. So remember, retail were selling, that means they're buying into that down candle, and then they're going to mitigate those longs at break even, right? So price comes back up to where they started buying. Again, retail selling, institutions buying, and then now we have retail buying, institutions selling. And when the market trades lower, it'll probably be a bearish candle or a couple bearish candles. On that retest, that's where they're mitigating these longs used to run the highs to get that liquidity. So you can expect them to mitigate price and then trade lower. So this gives us our entry right here. Okay, so that's one setup. I'm going to delete that and just do a trend line so I can show you the next setup. So this is where we get our entry, right here. And this one is going to be the kill shot. So let me label this. We're going to call this the kill shot. And the kill shot means they had to grab liquidity, then mitigate. Okay, so this is one setup we trade. And then the next one is the same thing. It's just a different method of how they grab liquidity. So we have price trading up, and then we see price just pumping up, right? It's pumping, pumping, pumping. And then eventually we just have a huge bearish candle. All right, so big bearish candle. And what this is identifying is retail traders finally caught on and saw that this is a bullish trend. And whatever reason, maybe it was a retest of this support, right? And it's just trending, and they're just buying, buying, buying. And then the institutions decide, okay, we're going to take over the market, and they pick up all the buy orders and push the market down, right? Because they're on the other side. So retail buy, buy, buy. That means institutions sell, sell, sell. They take over the market. And I'm going to push this over a little bit just so I can do a little bullish candle. All right, so we'll see a bullish move and then a big bearish engulfing sell. So what we expect is them to hold price under that bullish candle, because that's where the sell side took over. So they took over the market. Retail are going to be stuck in these longs, and when the market pulls back, we know they're going to hold the market lower. I meant to put this purple. Boom. So we look for our entry right here. So you can see it's the same thing. It's grabbing liquidity, but the only difference is they didn't have to buy into it to run the highs. The retail traders did it themselves. They were just buying, 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 and then institutions took over. We hold price under that, the level that they took over, because they're not going to let the retail traders out of the market. So we enter sells here. So you can see pretty much the same idea. It's just they had to manipulate over here. So this is going to be our entry, but this setup is called the sniper. So right here, so boom, So that's the difference. There's same thing. It's just grabbing the buy side of the retail traders. That way the institutions can enter their shorts. So you really just have to see how they're grabbing the liquidity. So these are the only two sell setups I trade. And then for the buy setups, it's going to be the same thing, just flipped. So we're going to go down here. We have price trending down. And then we have, this is the example I just showed y'all earlier, but we're going to do it again. So we have a support. We know retail traders are buying. We have our buys. Let's make it green. We have these stop losses on the longs. Make it red. And then we have those protective sell stops at our stop loss or just under. And so the two patterns we trade for this is if the retail traders have the market moving up, so you'll see a green candle, a green candle. So that means retail traders are buying, and then the institutions pick up the other side to run the lows. So we have that bearish, big bearish candle, take out the lows. That grabs the liquidity down there. So retail traders are taken out of their longs. They are triggered into shorts. So they're triggered into shorts, and then price trades higher. This is where they're going to have to mitigate, right? Because they entered shorts here because retail were buying, institution was selling. Now retail selling, institutions buying. So we know the intention is going to be long, and they have to mitigate those orders. So when price comes back down to that little bullish candle that they were selling into, that's where they're going to mitigate the orders. So this is our kill shot, mark it purple, and this is where we look for our buy entry where they are mitigating. So we look for our entry there, and price continue up. So here's our entry there. So that's the same thing you can see as this setup here. It's just flipped, right? See how it's a little bullish, that gets taken over by the bearish, and then it's a little bearish that gets taken over by the bullish, and then trades lower, and then trades higher. So the next setup is just going to be the double bottom, and the most common retail pattern is the double top, double bottom. That's why we know there's so much liquidity under there, and why they are always appearing in the market. Those equal highs and equal lows attract the retail traders' eyes. So the next move is going to be if we just see price spike down through the lows, we just have a bearish candle like this, which will be retail selling. Maybe there's sell stops below these lows, and then it's just in a downtrend, and there's retail selling, and then we have a big bullish engulfing candle trade higher. We know that they grabbed enough liquidity down here to take over the market, and they're going to hold price above that retail bearish candle where all the retail traders are trapped. So boom. And then when price retests, like I said, we expect them to hold price higher. So price comes down, that's where we enter the market and take price up. So literally these are the only setups I trade. And if you've seen my analysis, these are the only trades you really see. So these are the two bullish setups we trade, and these are the two bearish setups we trade. But the main thing is first identifying the liquidity, like the double top, double bottom, equal highs, equal lows, all that good stuff, and then finding the setup, because you have to see how the institutions grabbed the liquidity. So identify the liquidity, identify the setup, see how they trapped with that setup, and then you find your entry. So I'm gonna go to the chat real quick. Can I enter the NZD USD buy? So if we go look at it, this setup, you're already a little bit late. So if it does come back down again, for those of you that are probably watching this recording, and the Discord, we go to it, you can see this is the trade I sent out. So you can see here on the 4-hour, price was just then rejecting the kill shot, the sniper. So you see how price just ran these lows, see these equal lows, the lows, big move down and then aggressive move up. Let's go look at those examples I just showed y'all. I think it was on gold, somewhere way down here. Okay, there we go. So that's the setup right here. See these equal lows, bearish move down, and then bullish engulfing. We go back to the Discord. That's the setup we're trading. And then we have some imbalance in here, which is, you can see this wick here and that wick there. There's been no fill in price. So you can expect price to fill in that gap. The same way people trade their Sunday gaps, like, okay, the gap's gonna fill, right? It's kind of the same thing. It's just a void in price. So, and then we have these highs here. They already grabbed liquidity down here, so likely gonna move price up. We'll hit our take profit and then maybe look for a short in here. But this was the buy I sent, and you can see if we go back to NZD USD, go back to the 4-hour, this is the trade setup. Let me move this down, zoom in. So you can see entry here and price rejecting that candle body, that down move, and moving up. So a few more pips, maybe 10 more pips. I'll put stop loss at break even and just let this trade ride. But to answer your question, I wouldn't enter it yet. Maybe if we get another retest. This came down 3 times and rejected, so definitely should have got in. Another question, how long would you say it takes someone to master if they already familiar with construction? Okay, so yeah, you definitely want to learn the retail side of the market first, just because if you don't really know where retail traders are trading, patterns they trade, reasons they enter the market, it's going to be harder for you to understand the institutional side because it's grabbing that retail liquidity. So first you need to know where the retail liquidity is. So however, if you're a beginner trader and you're just trading technicals or you're taking courses or teaching you technicals, they're pretty much just showing you how you're going to get trapped in the market. So it's kind of good to study that at first and lose at first, then apply the institutional side and it'll really open your mind and you'll see like, okay, dang, that's why I've been losing. I really see both sides of the market now. But really we trade two different patterns, 2 different ways. So we have 4 setups, 2 bearish, 2 bullish setups. We know the intention is just grabbing liquidity. So as long as you can identify liquidity first, and then you look for these setups second, there's no reason you can't learn this really fast. Everyone learns different, so I'm not going to give you an exact time period, but with you already knowing the retail side of the market, you'll definitely be able to understand it better. Yeah, so yeah, 2 years of trading retail, you should be pretty good. That was me too. I lost for about 2.5 years and I was only trading retail. But I'm going to show you all this gold setup if you haven't seen it yet on the last webinar. So let's go ahead and just look at a step-by-step process as how we would see the market as a retail trader. So I'm gonna use this tool. It's a replay. I saw this setup play out over the last 2 weeks. I'm not gonna lie, I did not take the setup. I kind of missed it, and I don't really watch gold too much. I'm mostly trading the majors, but here's a great example. So as a retail trader, if you were looking at this price action, it's forming this little wedge or whatever you want to call it. But mostly what we're looking at is the market structure and what price is doing. So we can see here, we have all of this rejection coming out here. So this is obviously going to be a retail resistance, right? So we have retail resistance here, and I'm gonna make this just light blue. So retail resistance, that means when price is up here, we will be shorting. But we also see this little bullish trend line. I like to draw mine on the candle bodies so you can see, you know, it kind of plays out a little bit cleaner. If you want to do wick to wick, that's fine. But when you go to the line chart, it's really the structure is the candle bodies, right? So we're just gonna draw our trend line like that. I don't even use trend lines really anymore. So as a retail trader, we are looking for a possibility of some longs here, but really we're looking for shorts out of that resistance, right? And you can kind of call this a head and shoulders if you want. So that's a retail sell pattern. So here would be the left shoulder, right? And then this would be the head, and then this would be forming that right shoulder. So really retail traders are looking for sells here because of all this rejection and intending price to fall down here. So what we're gonna do is, as a retail trader, what we're taught to do is whenever the market is in this resistance right here, we look for sells. And then for the breakout traders and people, when this trend line breaks, price breaks this trend line, they're gonna have sell stops below this low, because that means they're shorting here, and then when price breaks that low, you see it's out of that trend line, so they're gonna be entering shorts here as well. So we're gonna go ahead and hit play on this. So you can see price moving up, and then price going into the resistance, and then big move down, right? So retail traders are like, okay, cool. Head and shoulders, our trend line broke, we're in shorts here. And so retail, this is all retail selling, right? Retail short, short, short. And then if you watch this next move, let me hit play. I'm gonna bring this up here so you can see it better. Okay, the next candle, boom, takes out that low. This is grabbing all the retail sells, right? So retail are selling, 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 mainly selling there below that low. And then boom, institutions take over the other side of the market, right? So that gives you your sniper zone right here. So you know that retail traders are stuck in shorts inside of that box, because that's where, you know, that's the down move. That's all the retail selling. Price goes up. They're going to hold price above here because they're not going to let the retails out of these shorts. So your entry is going to be that retest of this candle. And you can see the next candle, this wick, let me move it over. It came down and touched it perfectly. So if we look at the open, high, low, close up here, this down move, we'd be looking at the open, right? Because up here it opened, that's where the retail were selling. So we look at the open of the candle, and it is 1430.88. Price then takes it out. So you're looking for a retest at 1430.88 for your entry. And then let's look at the low of this candle here, right? So we'll look at the low now. The low of that wick is 1430.42. So 4 pip drawdown into the candle, and then the market reversed and took off, right? So that would have been our entry. We're on the daily time frame, and that's only 4 pip drawdown, which is insane. And then price just takes off. You can see, boom, right? So retail traders trapped, market goes the opposite way. The intention is price up, but they create this pattern to entice these retail shorts first, and they pick up the retail liquidity. That way they can move price up. So if you took this trade, like I said, that was 4 pip drawdown. And let's look at the price range. So we know 4 pip drawdown, but from our entry, price came up here over 1,000 pips. Maybe you closed here. There'd be no reason to close here. Big bullish move. Price just shooting up, shooting up, shooting up. Okay, price started falling. Maybe you closed down here 600 pips, right? So whatever it may be. But I want to go look at this setup again on the lower time frames as well. So let's delete some of this stuff. And we'll go look at this example on the 4-hour, and it'll help you really see it as well. Let me go, we'll just go to this area here, go to the 4-hour. Okay, so same setup. Remember, we have this resistance area, we have the trend line here. So this is gonna probably be some retail buying, but ultimately selling here, and then sell stops below the low. So let's go ahead and hit play, and the market's going to move up. You can see bouncing off the trend line and then going up. And right here, you can see this is our major resistance. So if we just were looking at this price here, maybe we weren't analyzing the daily, but we would see this area here, a lot of resistance in here, and then shorts off of these highs, right? That's where retail traders are gonna be selling, and then sell stops below that low. And you can do your big trend line again, whatever it may be. Let's go ahead and zoom out and draw our good old trend line that we're taught to use. Let's just go with the wicks this time. So wick, 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 valid trend line, right? So retail traders are taught to buy the trend line here, and when price breaks the trend line, they'll be looking for shorts. So let's go back and look at price. Oops, meant to zoom in. All right, so we're looking at price here. We'll hit play. So all this rejection out of the resistance here, big aggressive move to take out the lows. So just looking at this, as a retail trader, you're super happy right now. Price is just falling, price made a new low, broke the trend line. Imagine how many retail traders will be selling right there, right? I guarantee you everyone on this call at one time when they were trading or started trading, they were taught to be selling this setup. And then you can see once that low is grabbed, look at that. Price just takes off, right? So let me go back here. Okay, so retail selling, and below here, more sell stops. So sell, 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 sells, more sell stops hit. That means the institutions can grab up all of the other side of the market, which is the buys, and shoot price up. And that's what they do. Big bullish move and then big bullish move up. There's no way retail traders can move the market like that. I mean, just look at this candle right here. This candle alone was 300 pips, right? So institutions take over the market. So you can expect them to hold price above this area because this is all the retail traders selling. So everywhere right here is retail shorts. So we expect them to hold price above, just like we looked at on the daily. And let's hit play real quick. So price coming down. This is where you should be like, okay, let's get ready to buy this. We know the institutions took over the market. So right there, see how aggressive that looks? You don't want to be scared because we know that they're going to hold price above. So this is our buy. You can see that's our 4 pip drawdown right there. And you can see instantly rejects it and it comes back down, wicks it one more time. Let's move that over so you can see it. See that rejection off of that? They're not going to let price come down in here to let these people out. So you can see price rejects and they hold it above and then just run away with price. So that's a textbook example of what I have been showing you. So if you go look on the date, oh, that's the weekly. We go look on the daily, and you can clearly see that one of the examples I just showed y'all for that buy setup was that down move with a big bullish move up, and then you enter that retest because they're holding price up. See how they grabbed the liquidity? So, I mean, I guarantee you everyone on this call would have been selling this market here if they didn't already know about how I trade the market or see the market from the institutional side. So let's see, I'm gonna go back to the chart. Can you show the 4-hour setup? Which we did. You're gonna catch the recording later. Perfect. Sheesh, money bags. Yeah, money bags, right? So Like I said, 1,000 pip trade on gold, you could have been done for the month, right? So if we just exit out, so that would have been our buy setup. And let's do this. So we would have entered here, and price, we probably would have got out of the market right here. So that is 6 days and about 800 pips. So a lot of people don't even catch 800 pips in a month. So 6 days, one trade, and you would have caught that. So perfect setup there. And then on AU, let's go look at this real quick. So this is another setup I'm trading. You can see, let's go to the 4 hour. See how we have liquidity here, all the equal highs, equal lows. I'm looking for price to spike up, take out those highs, hitting our order block here or sniper, and then trading lower to grab this liquidity. So you can see here, I'm risking 30 pips to make 90 pips. So this is what I tell people all the time with that 1 to 3 risk to reward ratio, whether you're risking 10 pips to make 30 pips, 20 pips to make 60 pips, 50 to make 150. As long as you're trading 1 to 3 every time, you only have to win 33% of your trades. Because let's say we had this trade 3 times, the same setup 3 times. Boom, let's bring it down. And let's say, I'm gonna leave that arrow there so I can just have it for later, but let's say the market goes up, hits our stop loss, trades lower, and then hits our stop loss here. So just from these 2 trades right here, we had minus 30 pips, right? Minus 30 pips. And then the next setup lost minus 30 pips, but then this trade hit take profit for, why did he do that? For plus 90 pips, plus 90 pips. So simple math, you're down 30, now you're down 60, and then plus 90. So you still net profited 30 pips, even though you only won a third of your trades, or 33%. And there's a 50% chance the market's going to go up, 50% chance it's going to go down. So if you can just do some analysis and find some setups with proper risk to reward and take these setups, well, you only need to win 33% of the time to be a successful trader. You know, a lot of people, they win 80% of the time, but they over leverage on one trade and blow their account, or whatever it may be. So as long as you're finding 1 to 3 risk to rewards, see how I'm risking 30 pips, and see how the liquidity is at my target. Like if I had a target my 1 to 3 way down here, it doesn't really make sense, right? So, but with the 1 to 3 right here, and it's grabbing liquidity, then our trade makes sense. So you want to make sure you analyze the market with that institutional setup, and then also make sure you're using proper risk management and risk to reward ratios as well. So on last night's call, we kind of went over, or we did go over the 4 setups we trade, which is the kill shot and sniper for bullish setups, and the kill shot and sniper for bearish setups. So really two patterns, but a bullish and bearish version. So if you haven't watched that recording, definitely go back and watch that. But what we're going to do tonight is just go over a few examples and some setups. The first one I want to look at, I'm going to kind of compare institutional trading to the way we trade our institutional setups. So I'm going to do the same thing where we do our little replay tool, and I'm just going to drop it right here. So as a retail trader, if we were looking at the market right here, we would see that, okay, price is definitely, it was trending down right here. So I'm not going to go to the very top, but let's just say, okay, here's our trend line, right? So price is trending down. We have this high, and then eventually price just starts making these lower lows and lower highs all the way down. And eventually we find some support. So right here, we are going to identify our support area. If I can get the line straight. And let's zoom in on price now that we're focused on this area. So we have our support, and then right here we have our resistance, right? So we have support here, breaks it, and then now it's resistance, rejects it, resistance, 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 and support, right? And we all know a broken resistance becomes support. We break this trend line. This bullish move up makes a higher high, so it breaks structure. So I'm going to get rid of this trend line. So we now know we're in a bullish structure. Every retail trader should know this. So we have that retest of that broken resistance, which is now support. Price trades higher, and then you can see price comes back down. Same thing, the support holds, and price starts moving up pretty aggressively. And every retail trader does their little trend line. Right here, we have, this would be point A, point B, and this would be the entry on the trend line. So you can see a lot of bullish momentum, a lot of retail buying. Here's the retracement down back to this area. So this is gonna be some buys, right? So right now, every retail trader would be buying the market. And if you think you would not be buying, you can let me know in the chat why this would not be a valid buy for you, and let me know. But so if we go ahead and just look at this, we would be, as a retail trader, looking for these longs. Oops, I did not mean to do a ray. We meant to go with an arrow. We would be looking for the longs right here. So we're gonna let this play out. So like I said, you can make money as a retail trader. Obviously, everyone that was trading this structure here was making money, right? Maybe some people got stopped out here. Maybe they were selling, but real no institutional setup yet. This is just still valid buys looking for price to make a higher high, right? We have these higher highs, higher low, higher high, higher low. Retail anticipating price going up here. And you can see price starts moving up, right? So you can see here, everyone is starting to catch on, right? So there's the trend line, we have a major support, a lot of bullish momentum, prices taking out the highs. So every retail trader is going to be buying right here, right? So if all the retail traders are have now caught on and they're just buying, 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 well, that means the institutions will start selling. And you can see that next candle, boom, clears out all the retail traders. So we now know that this big bullish move up is going to be where retail traders are trapped after that big move down. So that's what we're going to identify right there. And whenever price comes back to that, that's where we're going to look to enter the market. Let's make this nice and clean. We're going to do that whole round number. So we're going to go 6575. Looks good, right on the candle body. So we would be looking for a short here. So we would go ahead and mark it up. So we are going to be risking about, I'll say 40 pips, right? So you can do 45 pips above these highs, or maybe 50 pips if you want. I guess we'll go ahead and just do 50, so it's an even number. So if we're risking 50 pips, that means we need a 150 pip take profit, right? That 1 to 3 risk to reward. Let me make sure all of this is clean. Boom. So this would be our trade setup. Perfect risk to reward ratio, perfect sniper entry when price retest. And now we're just waiting. It's just a waiting game now. So eventually we'll see price grab liquidity down here, and a lot of people the institutions might take profit. They have to pull price back. They can't just go down forever. That's where you start seeing accumulation occur. So we're going to let this play out a little bit. So right here, you can see these lows. Now price has spiked. So if we just look right here, so right at that area, that's where they grabbed liquidity under these lows. So now the market's going to start, you can see that major rejection back, and the market should start pulling back. And then this is going to start accumulating a bunch of orders. You can see maybe some trend continuation. Retail traders think it's going to continue down, whatever it may be. We're not really worried about this. We want to start identifying, okay, here's some equal highs. Price is going to spike up and take that out. Also, we can identify some imbalance. So there's no wick here, but usually there'll be like a little wick down. So you're going to go from, we're just going to go from the actual candle body where it closed to, oops, I make it orange. Okay, orange to this wick here. So see how that big gap in price, that's going to fill. So the same thing, we look over here, see from the wicks to that wick, there was this gap in price and it came back and filled it. Usually price is always going to fill in those gaps. So it's like a little void. So we're looking for price to fill it and then hit our entry. And then let's let it play out. Price is moving up. And then wick entry here, but price is going to continue up a little bit higher and then start to move down. So right here would have been our entry number 1, and our entry number 2 is going to be 50% of this sniper zone. So if it goes in, into drawdown 50%, which will be the 50 fib, that's where you enter your second order and keep that same stop loss above the high. So this would be entry 1, entry 2. You can see the imbalance is now filled. I'm going to go ahead and delete that so it's less stuff to look at. And now this is our short. So obviously that big move down right there, our entries in good profit. Let's go ahead and measure. So from entry 1, we had about 20 pip drawdown, 19 pips. And then from entry number 2, we would have had about 6 pip drawdown. But now price is up over 60 pips. So we would have stop loss at break even and just let this trade ride. So you can see we would just be in this trade. And then we would be targeting down here, our 150 pip target. And then you can see it would have got hit right there. So this trade was textbook. You can see how we had retail traders catching on here and trapped retail here with that big move down. And then price came back up to fill in the imbalance and to hit our sniper entry. And then we go back down here and target that liquidity at the lows for 150 pips.